Right, this video is a continuation of the combined accounts payable and accounts receivable setup videos. Following on from the last video where I was talking about making accounts inactive or active, if you look at the accounts payable, the same information exists on that screen as well. So as I mentioned, they are identical. If you look up the top here, you have your standard icons for printing, and on the right hand side you can preview the report. Now the reports you get out of this screen is going to be slightly different to the actual record screen. This here is a total screen. So the reports you get are obviously, as you see it from the screen, just totals of the account, what they owe, or what you owe depending upon what you're doing. Right, entering information into both of these screens. Let me just jump into this particular guy here. To enter information into accounts payable or accounts receivable, you have two sides of the account. Left side, right side. See at the top here? What's that writing up there will change. So it tells you what side of the account you're on. Now, obviously what that basically means is this. The left side of the account is going to increase the amount of money. In this case, it's accounts payable. It's going to increase the amount of money you owe. If you're in the accounts receivable, and I was entering information here, on the left side of the account, enter the amount added to this accounts receivable, it would be the amount of money. You're increasing the account by the amount of money they owe you, because it's money receivable, it's money coming in. Payable is money going out. Accounts payable is money you owe, money going out. Accounts receivable is money coming in, money that people owe you. Okay, so you can increase the amount of money. So like this guy here, if he mows the lawn for this customer once a week, and he gives them an invoice at the end of the month, and he wants to keep an accounts receivable for him, each time he mows the lawn each week, he would make an entry, mowed the lawn this day, and what he charged the client for that. So that would increase the account by how much money the client owes him. I think that's pretty fairly explanatory. If I look on this, click this here, this side is money payment received. So for accounts receivable, you would enter in the amount of money that they've paid you as they pay you, and that would reduce the account. And as you go along, you'll see as a quick review how much money you're owed. So accounts receivable, you're seeing here that Great Outdoor owes you that amount of money, Pex Machines owes you this, and etc. And if you look at accounts payable, it does the same thing. It shows you how much money you owe someone else. Now remember that accounts payable is money you owe someone else. So majority of the time, if you've got something, if you're purchasing goods or services, because it doesn't have to be goods, it can be services, similar to this mowing guy here offers a service to someone else, so they would have an accounts payable on their system because they owe you money. And on your system you have accounts receivable because it's something that is owed to you. So they would have an accounts payable on their system because they owe you money. Now, obviously in accounts payable, if you were purchasing materials from a hardware store down the road each month, you might not want to set up an accounts payable and record every single bit of every single entry, because they're already keeping a record of entries that you owe them. So at the end of the month, you pay their invoice. However, why would you want to keep an accounts payable and make double entries? If you've got a lot of work going through an account or a lot of invoicing, sometimes it stands to reason, depending on your business, you might want to double up on the entries. As you purchase materials, you might want to, on account, you might want to write down that invoice each day when you bring it home, write down exactly what you purchased, record it in an accounts payable, so at the end of each month, when you get the invoice from that person, they say you owe us $1,000 this month, pay it, you can go down their list, check it against your accounts payable and make sure that everything is gelling. Make sure they're not doubling up on amounts. Make sure that last month you hadn't already paid for something and they've included it again on this month, because that happens, guys. If it's relevant and you need to use these accounts for your business, use them. If you don't, it's just extra work. Just remember that. I think I've explained enough in dual content. I just wanted to explain briefly how the screens look of information that's the same for accounts payable and accounts receivable. Now I'm going to have to create individual videos because they are two specific areas and they need specific videos because they're doing specific things. The only other aspect I do want to point out, okay, so the only thing I want to talk about right now that's common to both screens is this setup icon down here. In both accounts payable and accounts receivable, you see a setup icon. This allows you to set up the accounts payable or the accounts receivable. By default, it's standard. So you can leave it as standard, or you can set it up and change it to audit. What's the difference between the two methods? Standard is simplistic. Audit method is more work. Just remember that. Simplistic versus more work. Depending upon your business and depending upon your needs, audit method, which is more work, may actually be right for you. If you're, such as I mentioned before, a gentleman that I know that's saving thousands of dollars each year, he enters every single item, every single invoice, every single item he purchases through accounts payable from his suppliers. If he purchases a bath, he writes the bath in there. If he purchases 20 lengths of timber, he writes that in there. And he puts it down in his accounts payable because he said that he has found over a month to month that he can have his suppliers doubling up on entries and overcharging him $1,000 at a time for something he's already paid for. And he says he wasn't aware of that until he started using the audit method and writing it down. He says it takes extra work over night time. He said he might spend the next 15 minutes each night entering in the information. And I suspect that he probably could spend up to half an hour some nights entering in the information depending upon what he's purchased. But he says in the long run, it's saving him money because it's money that he's got, which he would normally have given out and doubled up. And who's winning? The supplier's winning and you're not. So audit method means more work. Just be aware of that. Now, if I change this to the audit method, look what happens down the bottom here. This will change to audit method. That's on accounts payable. Accounts receivable, because I haven't changed that, it stays as the standard. So you can have accounts receivable set up as standard and accounts payable as audit if you want, or vice versa. Right, they're the common elements to both accounts payable and accounts receivable.